Oh, good afternoon, ladies and gentlemen. I've got with me Cameron Bagrie, who is the Managing Director of Bagrie Economics. Welcome, Cameron. Thanks for joining us this afternoon.
Good to be here.
Cameron, today we just wanted to talk a little bit about interest rates and the environment that we are in and perhaps are moving in to, and with particular emphasis maybe around what that means for banks, what that means for maybe New Zealand economy, businesses, and as commercial property investors and managers, what the sector might look like as we move perhaps into a lower economic interest rate or negative interest rate environment, and then perhaps the outlook for investors as well. So just wanted to touch on a few of those today with you if we could, a bit of a casual session. I guess firstly around interest rates, what are negative interest rates? What do they fundamentally mean to us and the New Zealand economy?
Well, I guess the easiest way to think about negative interest rates is not as though interest rates are negative, but just that they're incredibly, and some would say ridiculously low. Because what it's actually designed to do, if you look at what the Reserve Bank has been doing with particularly their large-scale asset program, which has been about buying government bonds, what has it been all about? It's been really about lowering the cost of capital. They're taking down what's called the risk-free return. And the Reserve Bank estimates that package, that program, has lowered long-term interest rates by anything between 50 to 100 basis points. So they're getting an awful lot of bang for their buck, albeit it is a really big program. What the Reserve Bank is really saying with negative interest rates being prospectively in store is that we're prepared to do more. And part of the reason they're prepared to do more is that the economy out there is still struggling. So the Reserve Bank has got more bazookas they can bring to the table. Now, if I have a look at how negative interest rates work in practice, this is probably the easiest way to think about it. The banks every night deposit money with the Reserve Bank, and the Reserve Bank gives them an interest rate or return, just like banks, when they take off a deposit, they give people an interest rate on the other side. Now, when interest rates go negative, well, the Reserve Bank is not going to be paying banks money. The money goes the other way. So you've got an economic incentive here for banks not to stash money with the Reserve Bank, to actually push it back out into the economy. But what a negative official cash rate also does is that it potentially takes those wholesale interest rates down to even lower levels, which really means an either lower cost of capital or risk-free rate. Does this mean that physical borrowing rates would turn negative? The answer is no. But it's trying to drag down those physical borrowing rates to really the lowest possible bounds the Reserve Bank can get them to.
And so what does that mean for banks? There's talk about low margins and margin pressure, and as you talked about, liquidity or willingness to lend out. Does that have an impact to banks in the way they act and behave from here on in?
Yeah, well, banks, of course, will be looking at a whole multitude of things. So the lower their cost of funds come down, i.e. lower wholesale interest rates, or lower term deposit rates come down, and we're still seeing term deposit rates come down, that allows banks to go a little bit more aggressive, hungry, in regard to writing those special deals in regard to housing loans or various other deals across the country. But of course, there's a bit of a caveat here, because we need to take account of economic risk or credit risk. And what we know at the moment is that, yes, in regard to the property market, the banks are still pretty hungry to write deals, but they have tightened up in regard to lending criteria. Why? Because the economic environment demands it. We're seeing exactly the same thing in regard to commercial property deals. Yes, good deals will still get done, but banks' risk tolerance has deteriorated in line with the economic environment. So yes, we are seeing what's called the monetary transmission mechanism, was just a fancy way of saying, well, the Reserve Bank's trying to get interest rates even lower. And that's been slightly offset by what we call the credit channel of monetary policy. Your banks being a little bit more cautious in regard to the nature of those deals they're prepared to write.
Okay, so we're looking to stimulate, I guess, the motivation for banks to deploy a bit more capital into the market and help move things along a bit, particularly in business productive assets of New Zealand, which Adrian Orr is clearly quite motivated about. There's a lot of other countries around the globe at the moment who are sitting in this negative interest rate environment, and Japan, for example, has been there for 2016. If we sort of go down that path in this lower for longer, low interest rate environment, what brings us out of that? Is there a sort of some tools that we pull to do that, or is it just function of inflation?
So if I have a look at the experience of Europe and Japan, which have had negative interest rates, the evidence is actually pretty mixed in regard to whether it actually works. The optimists say, well, look, it has worked because we've got growth, inflation has been up a little bit and unemployment has come down. Of course, we actually don't really know what the caveat, what the counterfactual would be on the other side if they haven't done it. Because what we've actually seen in a lot of those countries, particularly Japan and Germany, is the lower you take interest rates, in a typical environment, it's encouraging people to get out there and invest, get out there and spend your money. But of course, when you get interest rates at these real extreme ends, sometimes you can see some perverse economic responses. So in Japan and Germany, we've actually seen the lower interest rates have gone, people have started to save a little bit more. All of a sudden, in a lower interest rate world, you actually need a bigger savings pool. And this is where we've got to be pretty careful about how much we pull that interest rate lever. And in all honesty, Scott, like whether interest rates are 3.5, 3, 2.5, or 2, when you step back and look at the big picture, the cost of capital is really cheap. So I don't think the cost of finance is too much of a barrier in regarding good deals over the barrier in regard to whether they're actually sort of bankable.
You're quite right. One of confidence, really, and I guess sort of a confidence in the future of making good investment decisions and seeing a return on that. Who are the beneficiaries? We're seeing residential mortgage holders that they're benefiting from a low interest rate environment and support in the housing market, perhaps as a result of that. What about businesses? Is there a benefit there to businesses, and what might that look like?
So if I have a look at the residential market, first and foremost, as the cost of capital, the official cash rate, wholesale interest rates have come down, and deposit rates have actually followed, particularly because the Reserve Bank has said to the banks, look, we're going to give you cheap funding. You don't need to worry about what's called the core funding ratio, which is a ratio which banks really, they're incentivized to have so many deposits on their balance sheet. They've sort of removed that rule, giving banks a lot more flexibility. So there's less competition for deposits, so deposit rates are coming down. Great for borrowers, not so great for the depositors on the other side. But we've seen the housing market has been an immediate beneficiary of that. So if I have a look at the numbers in regard to household debt servicing as a share of income, the lowest we've seen since about 1999, which is about as long as I've seen data for. There's about 150 billion worth of mortgage debt that's rolling off in the next 12 months. And they're going to walk into the bank and they're going to be looking at an interest rate that's got a 2 in front of it. The interest rate savings are massive. What we've also seen is that the impact of lower interest rates, cheaper funding costs for banks have been a bit slower to flow into business lending rates. Such that the Reserve Bank actually said within their monetary policy statement the other week, look, when are going to start to collect some data? Because we've noticed this, and there's an old sort of adage, sunlight's a great form of disinfectant. So the Reserve Bank's having a little bit of look. They want to make sure that, yes, homeowners are benefiting, but business owners are benefiting as well on the other side. Now, to be fair, it's not going to be an apple for an apple style comparison, because writing a loan is a different risk to a business loan. So banks will be rightly looking at their risk profile. They'll be looking at credit risk within different sectors. Yeah, but I think the story is that the Reserve Bank is very mindful. They want everybody to benefit. Now, there might be different levels of benefit. One size does not fit all, but the Reserve Bank is absolutely fixated with making sure they get the maximum bang for their buck out of all those tools, what they're doing to try to take interest rates down to even lower bounds.
So putting ourselves in the mix as a commercial property landlord, funds manager, good for businesses to have a lower cost of capital, and hopefully to be able to start driving productive New Zealand and driving revenue and obviously bottom lines for themselves. Good for us as our tenants in a lot of our buildings, and so therefore robustness assists in paying the bills, including rent to ourselves as well. Cameron, really appreciate your time. Have a cracking afternoon, and we'll no doubt catch up with you soon.
All the best and take care.
Thanks, mate.